Today, we will talk about accrued expense, what it is, with examples and pros and cons. An accrued expense, also known as accrued liabilities, is an accounting term that refers to an expense that is recognized on the books before it has been paid. The expense is recorded in the accounting period in which it is incurred. Accrual accounting is the generally accepted accounting practices preferred accounting method. Since accrued expenses represent a company's obligation to make future cash payments, they are shown on a company's balance sheet as current liabilities. An accrued expense can be an estimate and differ from the supplier's invoice that will arrive at a later date. Following the accrual method of accounting, expenses are recognized when they are incurred, not necessarily when they are paid. An example of an accrued expense is when a company purchases supplies from a vendor but has not yet received an invoice for the purchase. Other forms of accrued expenses include interest payments on loans, warranties on products or services received, and taxes, all of which have been incurred or obtained, but for which no invoices have been received nor payments made. Employee commissions, wages, and bonuses are accrued in the period they occur, although the actual payment is made in the following period. Accrual accounting differs from cash basis accounting, which records financial events and transactions only when cash is exchanged, often resulting in the overstatement and understatement of income and account balances. Although the accrual method of accounting is labor-intensive because it requires extensive journaling, it is a more accurate measure of a company's transactions and events for each period. This more complete picture helps users of financial statements to better understand a company's present financial health and predict its future financial position. Accrued expenses are the opposite of prepaid expenses. Prepaid expenses are payments made in advance for goods and services that are expected to be provided or used in the future. While accrued expenses represent liabilities, prepaid expenses are recognized as assets on the balance sheet. An accrued expense is an event that has already occurred in which cash has not been a factor. Not only has the company already received the benefit, it still needs to remit payment. Therefore, it is literally the opposite of a prepayment. An accrual is the recognition of something that has already happened in which cash is yet to be settled. Accrued expenses theoretically make a company's financial statements more accurate, and may make it easier for companies to plan and strategize, as accrued expenses often yield more consistent financial results. Accrued expenses could be a financial reporting requirement depending on the company and its Securities and Exchange Commission filing requirements. Because of additional work of accruing expenses, this method of accounting is time-consuming and demanding for staff to prepare. There is a greater chance of misstatements, especially as auto-reversing journal entries are not used. In addition, a company runs the risk of accidentally accruing an expense that they may have already paid. Last, the accrual method of accounting blurs cash flow and cash usage as it includes non-cash transactions that have not yet impacted bank accounts. A critical component to accrued expenses is reversing entries, journal entries that back out a transaction in a subsequent period. Accrued expenses are not meant to be permanent, they are meant to be temporary records that take the place of a true transaction in the short term. Every accrued expense must have a reversing entry. Without the reversing entry, a company risks duplicating transactions by recording both the actual invoice when it gets paid as well as the accrued expense. Accrued expenses are prevalent during the end of an accounting period. A company often attempts to book as many actual invoices it can during an accounting period before closing its accounts payable ledger. Then, supporting accounting staff analyze what transactions/invoices might not have been recorded by the AP team and book accrued expenses. For companies that are responsible for external reporting, accrued expenses play a big part in wrapping up month-end, quarter-end, or fiscal year-end processes. A company usually does not book accrued expenses during the month. Instead, accrued expenses are booked during the close period. A company pays its employees' salaries on the first day of the following month for services received in the prior month. So, employees that worked all of November will be paid in December. If on December 31st, the company's income statement recognizes only the salary payments that have been made. The accrued expenses from the employee services for December will be omitted. Because the company actually incurred 12 months' worth of salary expenses, an adjusting journal entry is recorded at the end of the accounting period for the last month's expense. The adjusting entry will be dated December 31st and will have a debit to the salary expenses account on the income statement and a credit to the salaries payable account on the balance sheet. An accrued expense, also known as an accrued liability, is an accounting term that refers to an expense that is recognized on the books before it has been paid. Here are 5 key takeaways. 1. Accrued expenses are recognized on the books when they are incurred, not when they are paid. 2. Accrual accounting requires more journal entries than simple cash balance accounting. 3. Accrual accounting provides a more accurate financial picture than cash basis accounting. 4. Large, public companies with shares on stock market exchanges are often required to comply with accrual-based accounting as opposed to the cash method of accounting. 5. Accruals are recognition of events that have already happened but cash has not yet settled, while prepayments are recognition of events that have not yet happened but cash has settled. Hope this would help. Thanks for watching.